So does 4% inflation mean the death of your retirement? And if it doesn't, what is it that you can do about it? Hey, my name is Victor Medina. This is the Medina Retirement Planning Channel where I help you know it so you don't blow it. I'm a certified financial planner helping you to be successful in retirement. And stay tuned to the end of this video because we always share with you the secret to life. You just have to wait to the end of the video to see it. So hey, what am I talking about? You know, on May 12th, Wednesday, 2021, they released news about the U.S. inflation numbers and they pegged it at 4%. 4%! 4%! The world's ending, 4%! I don't know why I did that. I thought it was going to be funny. I actually think it's kind of interesting that anytime there's a little bit of news that comes out, the media has to make it seem like it's the most important thing in the world because, of course, they couldn't sell any advertising. If it just turned out that the news was, hey, things are probably going to be okay and probably the same for tomorrow, stay tuned. New numbers came out and the inflation number was at 4%. And what's crazy about that is that when I do planning for other people, I'm generally modeling an inflation number of almost 3%, which is actually higher than on average. And people are saying, well, you know, why are you doing that? I say, look, it might be more than what the average is, and if it turns out that things are going to be more expensive when you retire, then I don't want you living with me. So I need to have enough money to let you have enough money to last no matter what the inflation number is. What is inflation, and why is it going to be important? Well, inflation is basically the fact that things get more expensive over time. The prices inflate. And of course, inflation is terrible, right? I mean, if you have inflation, that's bad. Except if you're a bank, because usually when there's inflation, the reaction is to increase interest rates. And so if you're somebody that makes money off of increased interest rates, inflation's not too bad. Oh, and if you're a company that charges money for things and your stuff is getting more expensive, then you can get more revenue for what it is that you are selling. So it's not bad there either. So where is it that it's bad? Well, it turns out that if you were a retiree, inflation's actually not that great at all, might be a little bad for you. And here's the reason why. You know, unlike somebody who works, essentially when you're retired, your money, that's it. That's your money. So unlike somebody that it might be getting higher wages because they're working for a company that is earning more money so that they can pay you higher wages, in retirement, you're your own wage person. You're creating your own paycheck in retirement. And if things are getting more expensive, that means you have to consume more of your money in order to be able to use it to spend it on exactly the same stuff that you were spending things before. So inflation for a retiree isn't that great. In fact, it's probably one of the things that can most impact the success of your retirement because more and more people these days are having retirements that last 20 or 30 years sometimes, and for that reason, they need to have their money last. And that basically means that they're going to have enough money or plan to have enough money so that as things get more expensive over the course of the next 30 years, they actually have enough money to make ends meet and lead the kind of successful retirement that they're looking for. So, 4% inflation got announced, and is that bad for you? Well, look, if it turns out that 4% inflation is in fact a real number and it's going to continue to be at those levels for a period of time, that's going to be a bad thing. But we really have to dive in to what those numbers mean in order to understand them a little bit more. For example, there's a difference between core inflation and general inflation, and core inflation usually excludes some metrics that are tracking the costs of things. And when you exclude those things, it turns out that the core inflation number is a little bit lower than what the overall inflation number is. Core inflation is only at 3.something%, whereas the total inflation was at 4%. From that perspective, it's not as bad as a 4% number. The other thing we have to look at is whether or not that number, the 4% inflation, is in fact a true reflection of what the increased cost of things are, or is it a momentary blip in reaction to kind of weirdness that's been going on? Where are we in 2021? We're on the recovery end of a pandemic that shut down the economy for a considerable period of time and rewired how people spent money and where they placed value. It just kind of shook up everything that was on there. For example, one of the most ones that people were looking at, one of the examples that people were looking at most was the fact that people weren't buying new cars. They were buying used cars. And because there was, in fact, a shortage of used cars relative to the number of people that wanted it, it drove the prices of those used cars up. So in used cars, inflation was particularly high, right? The cost of the used car was higher than it would normally was, with nothing else having changed except the interpreted value of what that is, the expected value of that price of that car. It went up because there were more people that wanted it and there were fewer people there, so it suffered from inflation. Well, is that really a core fundamental number? Or is it more a reflection of sort of the weirdness of the time that we're in right now, specifically related to the recovery from the pandemic? And so only time will tell whether or not the inflation number is something that is a true number that's going to be going on, or whether it's just a momentary blip on the course of what we're going to be doing. The worst thing that the United States Federal Reserve can do is have a hair trigger response to increasing interest rates. They did that back in Europe back in 2011. It turned out that it really kind of stagnated their recovery, whereas the U.S. economy at that time didn't increase the interest rates, and they weathered the momentary blip that occurred from higher inflation numbers. So what should we do? Should probably just keep the inflation numbers where they are. But there is something that you can do specifically with respect to your retirement planning. Now, all retirement plans should consider what the impact of inflation is going to be, but there are ways of creating an investment portfolio that has inflation-protected securities, and those are generally included in any good diversified portfolio. More recently, in the model investment portfolio that we use for clients, we replaced one of the fixed income elements in there that was in there, one of the bond funds, with one that had some more inflation protection attached to it. So there's ways that you can kind of re-engineer your portfolio to help protect against the impact of inflation. The other thing you can do is make sure that you have time segmented your investments and your use of money. So if you need money to live off of, that's money that you should be relatively available to you, and money that you're going to need in 3 to 7 years from now should be in a protected format so that the variabilities of the market, the fact that the market goes up and down and might lose money, doesn't actually impact the money you're going to be using. Because if you had everything in a portfolio that could go down 20% or could be affected by just general cycles, when you went to go sell that so that you had cash to spend, you would be at risk of selling at a loss. And so if you start to time segment your investments, or you've got your short, mid, and long-term investments, it'll help protect against the impact of relatively short volatility or short duration ups and downs. And then just to make sure that you're protected against general inflation, the fact of the idea that things are going to go up more over time, you want to have some money set aside and for the long term meant to grow, and a really well-diversified portfolio that you're not looking at every time the news says that there's something going wrong, just to make sure that that continues to grow so that you have it when you need it 20 or 30 years from now. So those are how you're going to handle the inflation adjustments that are going to happen from time to time and what the impact of 4% inflation is for you. And now we get to the secret to life. People hate folding clothes late at night. I know that when we get to the end of the evening, the dryers just kind of run, and I'm not sure that I want to sit there and fold clothes for another 20 or 30 minutes.
This is the dullest moment I've ever experienced.
So the secret to life for today is let the clothes sit overnight. When you get up in the morning, most dryers actually include a wrinkle release feature. And if not that, you can just run the dryer for 10 minutes, release all of the wrinkles that have accumulated overnight, fold nice, warm clothes the next day when you're feeling more energetic about it, and have a peaceful night's sleep, not having to fold all those clothes in the evening. That, my friends, is the secret to life. Don't forget to hit the subscribe button and the like button for this video, and stay tuned for another great video on retirement planning. We'll catch you next time. Bye-bye.